Welcome back, you legends. I'm Dr. Cal. Let's get right into this weekly update video. So the stock market closed deep in the red on Friday. The S&P down 1.3%, NASDAQ 2%, and the Dow 0.86%. The different sectors looked like this, deep in the red across the board, except for the more defensive sectors like healthcare, like utilities, like consumer staples, and energy. On the weekly time frame, we can clearly see a more obvious defensive rotation into consumer staples, utilities, and some more strength coming into energy after being one of the lousiest sectors over the past couple of months since the June lows. Let's take a look at the stock market map, guys. Clearly, we only have this glowing green area on the map, and it's in healthcare, specifically the big pharma, the big drug manufacturers, and some of the healthcare insurance companies. Everywhere else you look, it's basically red. You can see that energy managed to hold up a little bit better than the rest of the market, utilities, as well as the consumer defensives. On the weekly time frame, guys, if we switch to the weekly time frame, we can get a much clearer look into how market participants rotated this last week. Clearly more into staples, healthcare, the more defensive sectors of the of the tech sector like Cisco and IBM, and some insurance companies. Oil and gas is back in the green, as well as utilities, tech, communication services, cyclicals, basic materials, and financials, all deep in the red. And the biotech sector, which was on fire, which was absolutely on fire the last couple of months, is now deep in the red as well. Let's take a look at the daily chart of the S&P 500. Look at this nasty bearish candle, this massive red candle. We gapped down on the day and then we closed down. So this is a very significant reversal candle. We have also managed to close below the 9-period moving average. The last time we did that was just ahead of the CPI reading, but we're seeing significantly more volume on this down day. So this is clearly a distribution day where big hedge funds are dumping positions. We're getting super close to a bearish crossover on the S&P 500. Now, we're not surprised at all that this sell-off came. We did talk about the significant divergence between the S&P 500 and the high-yield bonds, the junk bonds. Remember, guys, both of these work as vehicles of risk. High-yield bonds are the riskiest part of the bond market, and the S&P 500 is also considered a riskier asset as compared to corporate bonds and treasury notes. So they're traded very similarly, but the difference is that bond traders tend to be much smarter than stock traders, which is a cliche, but it's true. And let's point out why the sell-off was not a surprise. I'm going to start out with this double top right here. Back in February, right, we had a double top with a slightly higher high, and on the HYG we had a divergence. The HYG actually put in a lower high. This created a divergence between the HYG and the S&P. The exact same thing happened right here in mid-April, and let's take a look at the S&P. Look at that, boom, a high right here, a higher high later, HYG, a high, and then a lower high. This divergence led to a significant sell-off. Same thing here, guys. At the end of that May rally, the S&P 500 actually managed to continue to move up while the HYG was selling off, putting in a lower high, while the S&P 500 managed to put in a higher high, and it led to sell-offs. This divergence led to a significant sell-off, this one as well, and this one did as well. In fact, every divergence that I've spotted so far in the year between the HYG and the S&P 500 has led to a has led to a significant sell-off on the S&P 500. We had the last divergence right here, and we are now starting to see the beginning of this next leg down. In terms of price targets, we have a number of clear price targets. The first of which is $410 to close this massive gap that we have right here. The next price target is sitting at this key pivot zone that we talked about a lot in our previous videos. Why is this a pivot zone? Why is this a critical zone? Well, it acted as support right here in May, and then once we broke through it, it acted as significant resistance in July, and once we broke through that, we had a retest and then a massive rally. So this is a classic supply zone turned into a demand zone. So this is now a demand zone, and it is the clearest target for a sell-off in my opinion. First, we will have to close this gap right here at $410. Then we will move down to $400 if the sell-off continues. $400 on the S&P 500 on the SPY, and 4,000 on the index. It's a very important psychological level, 4,000. Then we have 3,900, 390 on the SPY, and below that we have another gap right here at 378, and below that we have the final gap at $366. The highest likelihood event, in my opinion, is a 10% sell-off from the top, which would take us down to this pivot zone, which makes sense to me. The second highest likelihood, in my opinion, is for us to close this gap at $378. Sell-offs significantly below that are possible, but in my opinion are not likely. They are still possible. It is possible, especially if we see significant spikes in volatility. Remember guys, when volatility starts to move up, technicals and the stock market begin to flash a lot of false signals. The market tends to trade more on news, less so on the technical developments in the market. So if we get a significant bearish development, like another spike in inflation, like a new geopolitical tension between the US and China over Taiwan, or an escalation in the war in Europe between Russia and the West, I can see how we could go even below these levels. Now, I did talk a lot about these statistics going back to 2000 as well as 1950, and there's an over 90% chance that we will not break this low. There's a 90% plus chance that this low will hold. Still, there's a 10% chance, roughly a 10% chance that this low will be broken, and that will depend entirely on the geopolitical and the global economic picture down the road. Now let's take a look at the VIX. The VIX finally gave us that significant sell signal. In my opinion, this is the strongest sell signal in all of the technical indicators that I follow. This VIX sell signal is the most significant. It leads to the most significant sell-offs, the biggest sell-offs, and it has so far been 100% accurate in predicting significant downturns in the stock market, and as well as predicting tops in bear market rallies. In fact, let's add the S&P 500 to this chart so you guys can see what I'm talking about. This orange line is the S&P 500, and every single time we had this signal on the VIX, we had the stock market top, and then we had a significant sell-off. This happened in November. In fact, the NASDAQ topped right around here in November 10th, I believe, and then we had a significant sell-off in the NASDAQ. The S&P 500 managed to hold up slightly better than the NASDAQ, but we did get a sell-off. The signal flashed again in early January, right here on the 4th of January, and it marked the top exactly. And then we had a massive sell-off in the S&P, and it marked the beginning of the bear market. Again, guys, look at this. February the 9th, it marked the top, and then we had that massive sell-off going into the war in Ukraine. Again, it marked the top right here and the end of the bear market rally towards the end of March, early April. And then we had that significant sell-off once again. In June, it marked the top, and then we had that massive flush down, that massive sell-off. It has now again marked the top right here, and the average sell-off after this signal flashed is about 7% to the downside, and that on the S&P 500 will take us down, let's see how far, to $400 on the S&P 500. So it makes sense. We might see some buying off the psychological level. And then next up, again, we have that $390 level. Let's take a look at the triple Qs. The triple Qs, again, they topped on the 15th, middle of the month. And we're now seeing a significant sell-off after three major indecision candles. Very close, sitting very close to this significant resistance line. We did not manage to get close to the 200 daily moving average, unlike the S&P 500, where we managed to briefly touch the 200 daily and then reject. We also have this bearish crossover on the NASDAQ, and it is quite often in bear markets to see the market take the stairs up and the elevator down. So we will see how this fares. I do have this ascending support line for the NASDAQ, and if we continue to sell off, we might see a bounce off the $308 level and perhaps off the $300 level towards this upper edge of this descending channel. Let's take a look at the IWM divided by the S&P. This is the Russell 2000 divided by the S&P. This is a ratio chart, and we did have this beautiful double bottom right here with a positive divergence on the PPO, but we are now rejecting off the 50 weekly moving average, and this is a key ratio chart to look at because we tend to have a massive rally in the stock market once we break above the 50 weekly moving average. So if once this sell-off is all done, if everything is said and done, and we manage to close above the 50 weekly moving average, let's say around October, November, that will be a beautiful signal to go back long, especially in the small cap stocks. Let's take a look at this insane stock going up 35% on Apple. I haven't seen insane trading like this in Apple since 2008. Since the bear market of 2008, we are now rejecting off this significant resistance line. And unfortunately, because this stock has been treated as a defensive play and it has been massively crowded, everybody and their dog has been buying Apple. This is actually now carrying significant risk to the downside. I would argue a larger risk to the downside as compared to the S&P 500 or the NASDAQ. Because of this insane rally that we've seen, this will spook a lot of holders of the stock, and once we continue to see significant moves to the downside, you will see a lot more selling into selling, and I could absolutely see Apple go all the way back to test this line, this red line. This line in the sand, guys, acted as a divider between bullishness above and bearishness below. As long as we were trading below this line, it represented bearishness in sentiment, and as long as we continue to trade above it, it represented bullishness and sometimes euphoria in these cases. So where do we go from here on Apple? We do have a bunch of very obvious gaps, right? We have a gap right here at 165. We have another gap right here at 157. And then we have this pivot zone right here, right? It acted as support. Once broken through, resistance, and once broken through, retested. It has been acting as support. So first price target 165, second price target 157, and third price target is 150. If this is indeed the beginning of a new bull market, we will need to see a lot of buying of Apple and basically everything from the S&P to the NASDAQ at this key pivot point. It's at 150 for Apple, and it's at 390 right here for the S&P, and for the Qs it's at 295, anywhere really between 295 and 307, this entire zone. We will need to see significant buying here, and we'll see if that happens or not, because we have a lot of economic data coming up. And for example, let's say that the economy continues to weaken and inflation continues to be strong. Even if inflation comes down, but it stays high and continues to be really stubborn, and then we see more structural inflation getting more and more sticky, things like rents and utilities, be very careful, guys. I have a very critical statistic at the end of the video, please stick around, that talks about how the stock market performs in raging inflation environments and how it performs when inflation is absolutely insane and it begins to move down. It's a completely different story in terms of performance in high inflation environments where inflation continues to go up, and in environments where inflation has stopped and is now moving down. Let's take a look at Tesla. Tesla is now forming a nasty double top right here with negative divergence on the PPO. We need to see this pivot zone hold at $840. We need to see this zone hold for bulls to have any chance at this continuing to move to the upside. If this zone is broken on Tesla, watch out for $750 right here. This is also an important zone because once we broke through it, we had a retest and then we rallied. So the mid 700s, watch out for that. If we break 840, and there's a very high likelihood that we could break this 840 level if the S&P continues to sell off and if the NASDAQ continues to sell off. Let's take a look at Bed Bath & Beyond, BBBY. I did say in my last video, guys, that do not be surprised to see Bed Bath & Beyond pull back all the way to $10. It did that on the dot. Look at that, 10.31, and then it held there. We have an indecision candle right here. This massive sell-off, guys, was prompted by Steve Cohen exiting his entire share and option position. I do have a separate video where I talk about all of the price targets for Bed Bath & Beyond and how I'm trading this stock and how I reduced my risk to zero while still having significant exposure to this stock in case the squeeze comes back on. To me, guys, I've traded a few squeeze stocks, and to me, this looks like it wants to stay at the $10 level for quite a long time before moving back up. So the way I'm positioned, guys, I am actually positioned for this to move sideways for quite a bit without me losing my position. This would be the worst time, in my opinion, to buy short-dated options on this stock because in all likelihood, they will expire worthless. Now, again, if you're interested in my trade plan, exactly how I'm trading this stock and how I reduced my risk and all of my price targets, please check out that BBBY video in my channel. Now, let's take a look at the 10-year yield. This is the 10-year yield, and look at that. So in my last video, I did say that I was waiting for the 10-year yield to go back over to the 50-period moving average on the daily chart and for us to touch the 3% level, and we did that. And so, guys, I continue to be of the opinion that we will see a head and shoulders formation right around here. We need to see a right shoulder, and that will probably mark the top in yields as long as inflation continues to move to the downside. We're now seeing inflation roll over in a lot of things in the economy, including things like gas, used cars, durable goods, so things like microwaves, washing machines, etc. All of these things are moving down in terms of price, but we are seeing some parts of the inflation equation being a lot more stubborn. Things like rents continue to move up. So this is an extremely risky time to be trading the markets, unfortunately, but we will just need to continue to take things one day at a time and trade the charts in front of us. Let's take a look at the 2-year yield. We are still flagging. We have this bull flag. We had this false break right here. We need to see the 2-year yield close above this level at 3.33%. For this sell-off to intensify in the stock market. 2-year treasury yields are a lot more sensitive to Fed action, so to the federal funds rate. And we do have the Jackson Hole Symposium at the end of the week, this week on the 26th, on Friday. So watch out for Jay Powell. I think that Jay Powell will very likely talk the market down, pushing yields up. Remember, guys, as yields move up, financial conditions in the markets will continue to tighten, and that's exactly what the Fed wants. The Fed wants financial conditions to tighten because that drives spending down, that drives earnings down, that drives inflation down, but unfortunately that also drives the stock market down. So in essence, Jay Powell, the Fed, they want to push the market down, not because they want to push the market itself down, but because they want to tighten financial conditions that will lead to reduced spending, that will lead to significant declines in the inflation equation. And unfortunately, a byproduct of that, a very important byproduct or side effect of that, is that the stock market has to give away a lot of the gains that we've seen so far. This is the 2 to 10 yield curve. This is the most important predictor of recessions. This indicator has predicted 100% of all recessions in recent memory in the past 120 years plus. Every single time we had an inversion in this yield curve where the 2-year Treasury notes netted a higher yield than the 10-year Treasuries. This led to a recession about 6 to 18 months later. Also, unfortunately, guys, we tend to see the stock market begin the phase of massive selling, the most important phase of the bear market, when this yield curve begins to steepen. Right? Let's take a look at what happened in 2008 as an example. This is 2008, guys. Look at this. We had a double dip in yields, very similarly to what we're seeing now, where we had a dip earlier in the year in March. Look at this inversion, this brief inversion at the end of March. And we're now seeing a second deeper inversion. This is exactly what happened in 2008. Look at that. And unfortunately, once that yield curve started to steepen again, once it started to move up again, that's when the market started to lose its mind and begin to sell off. In fact, let me add the S&P 500 to this chart so you guys can see what I'm talking about. So this is 2000. We had the inversion of the yield curve, and once the yield curve began to steepen, look at this massive sell-off in the market as the yield curve began to steepen, as it crossed back over from inversion to reversion, and we had that significant sell-off. The exact same thing happened in 2008, guys. Once the yield curve began to steepen again, we had a massive tantrum in the market, and as it continued to steepen, we had a more significant sell-off. Then yields started to cool down a little bit, and once we had this break in the yields again, we had this significant sell-off in the market. Unfortunately, this is forecasting another leg down in the market. When that leg down will come, it remains to be seen. But we tend to see a significant sell-off in the stock market in October and September, right? In midterm years, we are in a midterm year. This year is a midterm year, and we tend to see a huge sell-off towards the end of August. We're now beginning to see the very early innings of that sell-off, and then we tend to see another sell-off in September and one last sell-off in October. And November, December tend to be really beautiful outperforming months. So be very careful. We also tend to see a massive spike in volatility in September and in October in midterm years. And what massive spikes in volatility suggest is that the stock market will tend to move sideways for quite a while, then sell off very sharply in a matter of a week or two, then continue to move sideways for a while, and then sell off very sharply. So instead of seeing a slow and steady decline, the spike in volatility would indicate that these sell-offs will come hard and fast. So be very careful, guys. Now let's take a look at oil. Oil is now trying to base. It is trying to base at this very important zone. We had a double bottom right here with a very tiny divergence. On the 2-hour chart, you can see the divergence much more clearly. Right over here, right, we had a low right here. We had a lower low here. With a divergence, another divergence developed when we had one low here and a higher low on the PPO. So this is one divergence, and then we had one other divergence right here. So we have a bunch of divergences building up in oil that are indicating that oil will probably start to move back up. Oil is largely driven by macroeconomic and geopolitical events. And a lot of people are expecting Putin to start playing a lot of games with the energy supplies in Europe into this winter. He wants to punish Europe by cutting off supplies, and that will likely lead to a significant surge in U.S. oil demand going into Europe, as well as gas demand, U.S. Liquid gas demand going into Europe. And this brings us to the last stock that I want to show you today, guys, and it's Exxon Mobil. We have this absolutely enormous bull pennant on Exxon Mobil. This does not look to me like distribution. It looks to me like accumulation. Look at all of these green days. The stock closed above its open 7 days in a row. So a lot of people likely are buying Exxon Mobil. They're accumulating shares. We're not seeing a break above this resistance line just yet. If we see that, guys, if we see like a nice green candle that closes above this resistance line, and I do suspect that we will see that probably this week, this will lead to a brand new bull market in energy stocks. And just look at the potential risk reward here. The risk is that we break down out of this ascending channel, and that is a legitimate risk. We could see that. But my personal opinion is that we have actually bottomed right here in energy, and a break above will likely lead us to new all-time highs. In fact, if we just simply move from this level, let's say to the top of the channel towards the middle of September, that will lead to a 30% rally in Exxon Mobil. So, and remember guys, Exxon Mobil is the Apple of energy. It has the best risk-adjusted performance, so performance divided by volatility. It has the best risk-adjusted performance out of all the stocks that I've looked at, and I looked at a lot of energy stocks. I analyzed a lot of them, and Exxon Mobil always came back with the highest alpha, so the highest risk-adjusted, volatility-adjusted return. So I really like Exxon. The only thing I'm waiting for is a break above this descending line, and I'll probably be opening a position once I see that happen. And the beauty of this trade, guys, is that it can also act as a hedge against inflation and as a hedge if you are bearish on the market, which I am. It also can act as a hedge against upside risk and a hedge against inflation. So I really like this trade on all fronts, from a fundamental point of view, from a technical point of view. This is my favorite trade at the moment. And again, guys, if you are interested in following every single trade and investment that I make, as well as my watch lists and my trade ideas, please check out the link in the description for the premium Discord group. It's $20 a month, so if you want to support me, that's the best way you can do that, and you get access to all of my trading activity and investment process. Now let's take a look at this, guys. This is the rotation tracker, the stock charts rotation tracker. And I use this as a tracker to spot different sectors that are improving or weakening. Now, it is very obvious that energy, utilities, staples, and healthcare, okay, all of these yellow sectors in the market have been weakening over the past couple of months because we had that massive risk on move in the market and this absolutely massive rally in the NASDAQ. As we start to see rotation out of this trade, remember guys, this trade has been an extremely profitable trade. So all of those who have been in this trade on the upside will have been taking profits at the top, and now looking into rotating into sectors that do well in the back half of the year, in the winter, and that tends to be energy, as well as beginning to hedge against volatility in September and in October, and that tends to be in healthcare and in staples and utilities. So all of these weakening sectors will now be moving into the improving sectors, and all of these improving sectors and leading will now be moving down to weakening. I'll keep an eye out on this tracker for you guys, and I'll update you next week as well. Now guys, I do want to discuss a lot of bottoming indicators in the market, and this is the most important question, right? Was June the bottom? Are we going to see a significant sell-off? Is this just a bear market rally or a brand new bull market recovery? This historical data will help us answer that question. And this is S&P 500 stocks above their 200 daily moving average. This is a breadth indicator. It looks at how many stocks in the S&P 500 are participating in a rally at any given time. So back here in June, we were sitting at a historically low reading in breadth. We were sitting at about 11. And we had this significant breadth thrust to around 45. So I marked the low and I marked the high, and I looked at previous times where we had a similar reading. The last time we had a reading like this was back here in early 2020, after the stock market bottom was in. The previous time was back here in late 2018, We did not get as low on this reading, but we got pretty close, so I included this reading. And it was also after that major low. Same thing here, guys. In 2016, it came after that major low. Now, this is not a very comparable reading, but because we did not get as low in the sentiment, and it makes sense because this was a correction in a bull market, not a bear market as we are seeing now. This was the reading in 2011. We got very close to the reading that we saw earlier this year, so I included this reading. And then we had this breadth thrust crossing over above 45, and that did mark the low. This reading came after the major low, but we did have a significant sell-off come after that. And in 2008, we had a couple readings that I want to show you. The first reading right here, the sentiment did not get as bad as we saw this year. So this is not a directly comparable reading, but we did get a crossover above 45, and unfortunately that marked the top of the largest bear market rally. It was a very similar bear market rally to what we're seeing today. We had the S&P 500 rally to the 200 daily moving average, pretty much the same way we saw the market rally to the 200 daily moving average the last couple of months. But sentiment and breadth was not as bad at the very base. If we look at the reading after sentiment gets as bad as we've seen it this year, the bear market low was already in. We did have one last sell-off right here, but the bear market low was in. Let's jump into one other breadth indicator. This is the percent of stocks above their 200 daily moving average. So this looks at all of the stocks in the stock market, not just the S&P 500. So this is a much broader indicator. And again, I looked at every single time where we had breadth collapse to similar levels to what we've seen in June, and then we had a breadth thrust to around the top that we've seen last week. The last time again we had that reading was in 2020, the low was in. 2019, the low was in. 2016, the low was in. 2011, the low was also in, but we had that significant sell-off afterwards. And 2009, the low was in. Unfortunately, we have one false reading. And that again was in that massive bear market rally in 2008 that took us to the 200 daily moving average. And look at that. The starting point was exactly the same as it was for us in June. And it topped at almost the exact point that we're seeing now. So out of the 7 readings that we've seen in the historical data, we had one false reading, and then we had 6 readings that marked the bottom. So how am I trading this? The way I'm trading this, guys, is that I am going with the odds. I'm not going against the odds, I'm going with the odds. The odds suggest the low is in and that a bout of volatility is coming, and that's how I'm positioned. I'm positioned in a way that respects the fact that the low is probably in, but also respects the fact that volatility is still in the market and we will see significant sell-offs more likely than not. Now, if the data changes, if we see a more significant sell-off in the market, if we see the June lows break down, if we start to see more significant economic data come in, inflation continuing to move up, the economy weakening more rapidly, I will reposition at that point, but I will have to respect the odds. This is one other study that I want to show you guys from Chiovaco Capital. Please check their videos out on YouTube. And this looks at one other breadth thrust reading. This breadth thrust reading looks at the 50-day moving average on the S&P 500. So you need to have 90% of all stocks in the S&P 500 closing above their 50-day moving average. They looked at more than a dozen times this happened going back to 1942, and then Chiovaco Capital marked these sell-offs that came after that reading. So if we look at the historical data, the worst sell-off in all of the readings that we've seen since 1942 would take us down to 3,800. The second worst would take us to just below 4,000. And the vast majority of those of the pullbacks after this reading would take us back above 4,100. Okay, so this just speaks to the odds of the pullbacks that we can expect. And if we put this together with the critical pivot zones that I talked about at 3,900 and 3,800, this makes a lot of sense to me. And I'm leaning more towards the worst case scenarios, not the best case scenarios. So 4,000 on the S&P all the way down to 3,800, in my opinion, is highly likely. There's another study that I want to show you guys. This is from Sentiment Trader, and it looks at the Dow Jones performance in high inflation times. So when inflation was high and declining, the Dow Jones returned 100% the following year. When inflation was high and rising, it returned negative 62%. So again, the $1 million question remains, did inflation top? Are we going to continue to see lower and lower readings of inflation? That will be a major tailwind for the markets, allowing the markets to continue to climb higher. There's one other study that I want to show you. Here's another study that I want to show you guys, and it's also about breadth thrusts. And again, going back to 1942, this signal had a 93% win rate. So the way to look at this, guys, is that it speaks to the odds of how the market tended to perform after a major thrust in breadth. So when you see a significant rally in the market with a lot of stocks participating in that rally, clearing that 90% threshold, we tend to see a 93% win rate. A year later, 93% of the time, the stock market was higher. 7% of the time, the stock market was lower. It is very important to point out, guys, that these are statistics and they speak to odds. They're not predictions. They cannot predict what is going to happen. Nobody knows what is going to happen. These figures only speak to odds. You have to trade based on the odds and your intuition as a trader, based on the statistics and the data, the economic data and company earnings. So fundamentals, technicals, and statistics. You have to put all of those things together to have the best chance of coming out of the other side with profits and no losses. Now let's take a look at what's coming up this week, guys. We have the Chicago Fed National Activity Index on Monday. Tuesday, we have the S&P 500 Manufacturing PMI. On Wednesday, we have goods orders and core capital equipment orders. Thursday, we have jobs numbers and the latest revision to the GDP. Watch for a revision down or up. A revision down would be bearish. A revision up would be bullish. Friday, we have PCE, the dreaded personal consumption expenditures figure, the preferred inflation measure by the Fed. And we also have the Jackson Hole Symposium starting Thursday and ending Saturday. Expect Jay Powell to come out and talk the market down to try and tighten financial conditions again. Talking the market down is just a term that you hear a lot in the news. It is basically, air quotes, legal manipulation to bring the markets down. It's only the Fed that is allowed to do this. Only the Fed is allowed to legally manipulate the markets and move stocks down. Friday, we also have consumer sentiment index and 5-year inflation expectations. So a lot of volatility coming up on Friday. And in terms of seasonality, we tend to have that massive sell-off towards the end of August. So brace yourselves. After Jackson Hole, we could see a spike down. Get ready for anything really, but taking a look at the aggregate midterm years, we always tended to have the sell-off towards the beginning of September. So watch out next week, guys. Be careful out there and smash that like button, and I'll catch you in the next one. Bye-bye.
Oh, wow.